By early 2026, the gold market reached a historic peak, testing the $4,600 to $4,800 per ounce threshold. This environment has triggered a significant revenue windfall for Tier 1 gold producers. Across the sector, cash is flowing into these companies at rates that have historically been out of reach. However, high realized prices come with a secondary pressure. As gold prices rise on the primary axis, producers face a steady climb in baseline costs. Royalty obligations and inflation continue to impact operations. This surging revenue fighting an inflated baseline forces producers to choose how they allocate capital. They have to decide how much of this windfall to protect and how much to reinvest. Today, we are evaluating the first quarter 2026 performance of two major players, Agnico Eagle and Alamos Gold, to see how each firm is navigating this financial environment. While both companies benefit from the same bull market, their results diverge based on a single factor, the specific mechanism they use to allocate their cash. Mining executives in 2026 face a clear trade-off. Do you capture immediate cash flow to return it to owners, or do you reinvest it now to pursue a different scale in the future? The first path is the heavyweight operational philosophy. This model focuses on stabilizing existing regional operations to harvest current high yields with as little disruption as possible. The alternative is the challenger philosophy. These producers funnel capital directly into major infrastructure projects, spending today to lower long-term unit costs. Neither strategy is objectively wrong, but each aligns with a very different set of investor goals. Agnico Eagle represents the established Tier 1 heavyweight. They operate a harvest and return model, prioritizing cash flow from a portfolio of mature, high-quality assets. In the first quarter of 2026, their production reached 825,000 payable ounces. Despite sector-wide inflation, Agnico Eagle maintained an all-in sustaining cost of $1,483 per ounce. By combining that cost control with record gold prices, Agnico Eagle generated $732 million in free cash flow in the first quarter alone. Their regional operating model and geographical scale act as a buffer against market volatility. This stability allows them to convert mining operations into a consistent cash engine. Agnico Eagle returns 40% of its annual free cash flow to shareholders. Part of that is a 45-cent per share quarterly dividend. They also expanded their share repurchase program to $2 billion, emphasizing equity value over rapid expansion. This strategy involves a specific trade-off. By returning this much cash, Agnico Eagle accepts a steady growth rate of 20 to 30% over the next decade, rather than chasing a massive production spike in the short term. For Agnico Eagle, gold production functions as a yield vehicle. They prioritize immediate shareholder returns over speculative global growth. Alamos Gold is executing a different playbook. As a high-growth challenger, their capital is currently being deployed to transform their production profile. Looking at their Q1 results, the company produced approximately 123,900 ounces. During this phase, they are seeing higher unit costs. Their Q1 all-in sustaining costs reached $1,862 per ounce. These costs reflect a period where sustaining and growth capital are being spent at the same time. Alamos is funding massive projects today that are not yet contributing to the bottom line. Despite these capital requirements, management signaled confidence in the company's future cash flow by increasing the quarterly dividend by 60%. Once the shaft and the mill expansion are integrated, their all-in sustaining costs are projected to drop 18% from current levels. Investors in Alamos Gold are accepting a period of high capital spending today in exchange for a significantly more efficient production engine in the future. This matrix assesses the risk of each model. Agnico Eagle's operations are optimized, meaning the stock is sensitive to macro forces like dropping gold prices. Alamos Gold's concern is execution risk. If the Island Gold expansion is delayed, cost savings take longer to arrive. Risk is not just a single number. You have to decide if you are more comfortable with the market's impact on gold prices or the management's ability to execute a complex engineering project. These two models fit different types of portfolios. A foundation builder is looking for low volatility, immediate cash flow, and a reliable dividend history. If that matches your goals, Agnico Eagle fulfills that role through its harvest and return strategy. An alpha chaser is willing to take on construction and execution risk today in exchange for aggressive margin expansion and future growth. If your strategy involves taking on that risk to leverage future scale, Alamos Gold is currently optimized for that path. Take a moment to see which allocation matches your own goals. This analysis is purely for educational purposes and is not financial advice. If you found this comparison useful, hit the like button, subscribe for more sector breakdowns, and let me know in the comments which miner you are watching in 2026.